Hello and welcome to a joint webinar with Star USA Training and TRG. Today is Tuesday, June 11th, and we're very happy to have Travis and Meredith join us to share their knowledge on bonds and to talk about trends they're seeing in protectionist tariffs. They won't leave you hanging. They also have included some ways that they've found to help mitigate the impact. If you're watching this on YouTube, there's a link in the description to the website so you can access slides and any materials. We're recording the webinar and we'll send it out to you along with the slides and materials in the coming weeks. I've collected several questions from attendees that were sent in before the webinar, but I'm sure you'll come up with some good ones while you listen. The Q&A feature is available and we have set aside time to answer as much as we can at the end. And there is one NCB FAA credit available for continuing education credits for CES and CCS participants. That code's provided at the end, and we'll send out instructions in the email with the recording. Most of you know about Star USA. We're a consulting, advice, training, and services firm in the field of international trade and compliance based out of Northeast Ohio. My name's Jo Harper. I'm a principal at Star. There are so many reasons that I'm excited to bring you this webinar. One of them is that I'm a giant nerd and I love to learn about new things. Cargo insurance and the practical application of bonds is something that I'm passably knowledgeable at, but by no means an expert. TRG is joining us today and they are the experts in those topics. The second, more ridiculous reason is that I'm from Montana and I went to college in Bozeman, go Cats, which is where TRG is located. We at Star have been partnering with TRG for decades when our clients need customs bonds, and we've found that they are knowledgeable, communicative, and ethical in the services that they provide. We love that they have a similar heart for education and sharing knowledge that we do. Travis Smith, extra fun for me to introduce because he moved from Ohio to Montana, which is the opposite move that I made. He is the president of TRG and someone I've worked with over the years. And I'm going to turn this over to Travis and to Meredith to share the screen to give us information on customs bonds and what's happening with them currently.
Thanks for that introduction. That was flattering and we appreciate it. And, we've worked with you guys now for 10 to 15 years, so we have a great relationship. And most of all, thanks for this platform to talk about customs bonds, cargo insurance, and trends we're seeing, especially with 301 tariffs. It absolutely impacts everyday importers, and how it ties into your customs bond. Your import bond can help protect your business and understand best what's going on and what you can do to run your ship as tight as possible. The first slide we have here, we'll just get into the basics of the customs bond. Now, as an importer, you got to understand the customs bond. When you understand why the customs bond's required, it helps tie everything together. You get a better overview of why customs requires you to have the bond. You understand your risk better. So a customs bond is a financial guarantee that protects U.S. customs. It does not protect the importer of record at all. U.S. Customs requires every importer of record for goods coming into the United States to have an import bond on file. If the importer of record fails to pay money owed to U.S. Customs, then the insurance company that underwrites the bond will pay customs that money. If it gets to that point where the insurance company, or the surety on this slide, we're calling the insurance company the surety, pays U.S. Customs in the event that the principal or the importer of record fails to pay U.S. Customs, then that insurance company or surety will still try to collect the money from the bond principal or the importer of record. Customs requires this bond. It's a financial guarantee that protects U.S. Customs revenue. It does not protect the bondholder or the principal at all. The bond is a three-party guarantee. So on that previous slide, we have the triangle showing the three parties. Here, we have the bond principal, who's the importer of record of goods coming into the United States. U.S. Customs and Border Protection, they require the bond, and a Treasury listed surety. The surety is the insurance company that underwrites the bond. They take the risk on the bond. TRG, we are an insurance agency or a surety agency. We represent Hanover or Hudson Insurance to write customs importer bonds. Now, the takeaway is that the customs bond is a three-party guarantee. That's different than traditional insurance policies, and it's a tool to protect the revenue for U.S. Customs. It does not protect the importer of record at all. Now, the surety or the insurance company is the party that has the risk in the agreement. You want to be working with an insurance agency that has really clear communication and is representing the surety well to work with the principal or the importer and the insurance company to make sure information is flowing back and forth and claims are addressed quickly and the customer service is happening the way you need it to. Now, in this next slide, we'll talk about how to calculate the bond size. There's a lot of confusion out there about this, and everybody needs a reminder on it. But in essence, what you do is you take 12 months in a rolling 12 months calendar period, in a rolling 12 months, the annual duties, taxes, and fees the importer pays to U.S. Customs. Multiply it by 10%, and that gives you your bond size. Now, keep in mind, the minimum continuous bond size is $50,000. After $50,000, it goes up in $10,000 increments. So 50,000, 60, 70, 80, 90, 100, up to 100,000. At the $100,000 bond size, it starts going up in $100,000 increments. It continues that all the way up. Looking at this equation a little bit closer, annual duties, taxes, and fees times 10% equals the bond size. Let's say you have a company that pays $300,000 in duties, taxes, and fees to U.S. Customs in a 12-month period. Multiply the $300,000 times 10%, you get to $30,000. There you go, the bond size, it's within the minimum. So at $30,000, you can place a $50,000 bond. If annual duties, taxes, and fees were $450,000, you multiply it by 10%, you get to $45,000. Again, you're safe. Well, you're getting really close, but you could get away with a $50,000 importer bond. Annual duties, taxes, and fees, as they go up, you multiply it by 10%, and you get to that bond size. And what else is included in calculating the bond amount? Breaking down that equation a little bit further, as an importer of record, the duties, taxes, and fees that you need to add together to input into that equation includes anti-dumping duties, countervailing duties, imposed tariffs, so 301, 232, harbor maintenance fees, and merchandise processing fees and excise tax. Depending on the importer, any one of those inputs might be significant, so it's important to consider all of those possible calculations to input into the master calculation. So there you go. Hopefully you have a good grasp on why the bond's required, why Customs requires it, and how to calculate the bond size. How does that carry over into what's happening today and what's really been going on since about 2018 with the trade war? If we get into 301 tariffs, the trade war started with the previous administration back in 2018 or thereabouts. We haven't seen the current administration take a step back. They have not stepped back from these tariffs as some may have thought they would have, about 4 years ago. In fact, we're seeing them engage more with these 301 tariffs. The Biden administration just announced $18 billion in tariffs on $18 billion on imports from China. So he's expanding these 301 tariffs. There have been some exclusions on the tariffs. Those exclusions are going to continue. They announced possible end to some exclusions on May 31st. They pushed that out to June 14th. So now right around the corner, those exclusions are going to expire. Some exclusions will remain in place, but by and large, the 301 tariffs are still a tool that the government is relying on to try to control what China's doing and, in their opinion, and being overly burdensome on the U.S. economy. And then if we look closer at the new 301 tariffs, they've announced tariffs on steel and aluminum. It's going to go from 7.5% up to 25%. Semiconductors, 25% to 50%. Electrical vehicles, 25% up to 100%. Batteries and battery components and parts, about 7.5% up to 25%. Minerals for batteries, 0 to 25%. Solar cells, a big jump from 25 to 50%, and medical products. including syringes and needles going from 0 to 50%, PPE 7.5 to 25%, and rubber, medical, and surgical gloves going from 7.5% to 25%. And, with those tariffs, what effect has it had on importing into the United States? How have U.S. companies reacted? And we've seen a big shift from imports coming in from China, and U.S. importers are sourcing from other countries, maybe Mexico or other countries in Asia. And this slide looks specifically at Vietnam. We've seen an increase in imports from Vietnam. Now, we've seen almost equal volume of imports increasing into Vietnam from China. So as these tariffs have pushed U.S. companies to import from countries outside of China, we've seen China increase their imports to those countries that U.S. companies have moved to. So what does that mean? It means that the tariffs have taken their effect, but will, looking forward, the government look to impose these 301 tariffs on other countries outside of China. Here on this slide, we have a quote from a representative of the Asian Development Bank. She says, a possible scenario is that after the November elections, whoever wins may change the policy, the 301 tariffs, towards Vietnam. So this is a forward-thinking and a possible scenario. But what we've just went over is that both administrations, both sides of the aisle, has embraced 301 tariffs, specifically with China. Potentially, we could see them use the same tool on other countries. What does that mean for a U.S. importer? What does that mean for a U.S. customs bondholder? You really got to be looking at this stuff in the news and be forward thinking and looking at your suppliers and critically thinking about your bond size, because you might be in the clear today, but maybe next year your supplier will fall under one of these 301 tariffs. How do increased tariffs impact your bond? Increased tariffs can result in you needing a larger bond. Now, the name of the game is being able to forecast and see the bond increase coming and not getting stuck in a cycle where you're repeatedly increasing your bond size before the anniversary points of the bond. Now, also, if you're able to forecast and see what's happening with tariffs, you can also get ahead of receiving a physical letter from customs and being caught off guard with a required bond increase from customs. By taking these steps, you'll know what to do. You're going to have good communication with your bond provider, and you're not going to be caught off guard. And on this next slide, we move on to a couple of graphs. On the left side, we have normal entries without 301 tariffs or increased tariffs on your goods. Looking back from present day, it stays pretty consistent. Now, if you look to the right, once you get hit with 301 tariffs, your duties, taxes, and fees that you pay to U.S. Customs, they kind of skyrocket. They go up significantly. So this is the data that Customs looks at for each importer of record. They look at from present day back 365 days. That's the data they have on hand. They look at this data, and once they identify that an importer of record is approaching or has exceeded their capacity for their importer bond, for a $50,000 bond, that would be $500,000 in duties, taxes, and fees, they send out an increase letter. Customs only looks back 365 days. They can't forecast out. As the importer of record, you know your data, you know your trends and how your importing might increase or decrease. You take that information and you layer it on what you can expect as far as duties, taxes, and fees, the rate from customs, and you forecast out, and you got to make sure you're going to have a sufficient bond for a full 12-month period. If your bond isn't sufficient for a full 12-month period, you potentially get stuck in a cycle where you continually just increase your bond to the minimum required bond increase amount that customs tells you to do, but it's not enough to keep you sufficient for 12 months. You end up spending a lot more on bond premium. You end up spending a lot more time and heartache on the bond. And very often, once you get stuck in that cycle, the surety or the insurance company is going to require collateral to keep the bond on file. So what can you do? You're on this webinar, you're engaged, and you want to be ready for what might happen. What you cannot control are these tariffs. And you can write your senator, you can write in for an exclusion, but the government's going to do what the government's going to do. We all know that. Once the tariffs hit, if they hit your goods, you can't control if you need a bond increase. If you hit the limit of your bond, customs is going to require you to increase that bond. What you can control is you can control where you import from. We talked about it a couple slides ago, but we've seen a lot of importers move their suppliers from China to Vietnam. Some of our biggest bond clients have moved their suppliers from China to Mexico, taking it very close to the US. So you can look at different suppliers in different parts of the world and have contingency plans in place. You got to monitor your entries and you got to monitor your bond sufficiency. And we have a tool for that. Here is the dashboard of TRG's compliance software. This is just the dashboard, just one quick snap to give you an idea of what you see. But you have 3 different scores: your current importer score. The higher the score, the better your compliance is. You have an unliquidated entry score and trade compliance score. Using this dashboard, you have 3 graphics and 3 numbers that you can use at a glance to see where you stand as far as compliance with customs. Further, for those of you that are in a compliance department within a very large company, what we found with our clients that are using this software is they're able to share this within the company with other departments that have overlapping concerns with compliance. And who doesn't have overlapping concerns with customs compliance, right, Joe? Mm-hmm. But it's amazing when you're able to assign a number in a graphic to a very technical discussion, how conversations can open up and how you can kind of spread the knowledge and the importance of understanding this across your organization. Now, if you're not a larger organization that has a dedicated compliance department, possibly you're a small or mid-sized company. I know we got a lot of you guys on this podcast. You got a lot going on. You can't have a dedicated compliance department, but with softwares like this, you can log in daily or weekly and get a snapshot of where your compliance is. Of course, this software includes the data and the specific entry information to back up these numbers, but this is a great tool to stay ahead of and have peace of mind and be able to have internal discussions about where you are as far as import compliance. This software also has great bond sufficiency reporting. In this example, in this snip from the software, the bondholder is at 46.96% sufficiency. So they have a lot of space to go. This will show exactly where you are as far as sufficiency goes. And as you get closer to 100%, you got to monitor it a lot closer. You got to see when your anniversary date is coming up and start to keep an eye on it. This bond sufficiency reporting goes into more detail. On the next slide, we have a couple tabs: sufficiency summary, quarterly breakdown, which is showing right now, report summary, entry summary. So all the data behind the bond sufficiency is available. But again, these snapshots we have here allows you to look at a glance. And we wanted to highlight this quarterly breakdown because a big part of bond sufficiency can be trends over the quarter or where you're going up or down. And as you'll see, this shows from present day looking back. The quarterly breakdown in the bond sufficiency calculation is not based on an annual calendar. It's not based on the effective date of the bond or the anniversary date of the bond. Customs looks at it at present day moving back. And that's why we broke it down this way on the slide. And then the final thing about this compliance software, and as an importer of record, where you need to know where you get the data to look at. On this next slide, we're going to highlight where we get this data. Now, every importer in the United States has, you have access to ACE data. Now, getting that access, it takes some legwork. And once you have the data, it's a true data dump. It's hard to sift through and know what you're looking at. Many organizations don't have the wherewithal or the resources to be able to effectively use ACE data. And that's one of the big rubs as an importer. What we've created with this compliance software is a user-friendly way to access this data. We take surety ACE data, so it is different than importer ACE data, but it shows this data in the compliance software captures all of your importing data, whether you have 4 different customs brokers or just one, you see all of your entries in this data. This interface allows you to see it in an easy to use, easy to manipulate way. And we think this is key to being able to stay ahead of whatever might happen with the next administration or between now and November, because it doesn't seem like it's going to be smooth sailing the way it was maybe in the early 2010s. Just a quick highlight on TRG and who we are. Many of you are already familiar with us, but we're an insurance agency, but we zero in the niche world of U.S. customs bonds, marine cargo insurance, and compliance software. Compliance software is what we just spoke about. Thank you for your time on those quick slides. I hope that was really helpful.
Thank you so much, Travis. We have so many questions for you, and I'm just going to start throwing them your way if that works.
Cool. Let's do it.
All right. So remember, if you're watching, you're welcome to ask questions you have, and we will give you the best answers that we have. Our first question is, what if you don't have the annual duties paid information to try to calculate your bond?
The first thing I would highlight is the minimum continuous bond size is a $50,000 bond. That minimum, you can't place a smaller continuous bond size. That $50,000 bond size is sufficient for companies that pay between $0 and up to $500,000 in duties, taxes, and fees to U.S. Customs in a 12-month period. So that would give a lot of you maybe some peace of mind. It's a really big ballpark, $0 to $500,000 in duties, taxes, and fees in a 12-month period. So maybe you don't have a really firm number on the duties, taxes, and fees you pay to U.S. Customs, but you should be able to know your annual dollar volume imported. So for a big percentage of the U.S. economy, your duties, taxes, and fees, if you know the value of good imported, you import over a 12-month period, it should be pretty easy to give you a good estimate of your duties, taxes, and fees, and whether or not you're within that $0 to $500,000 range to keep you in that $50,000 bond minimum bond size. Now, of course, there's plenty of U.S. companies that are way bigger or over that $50,000 minimum that pay more than $500,000 in duties, taxes, and fees. At that point, it's pretty critical that you've got to be able to capture this duties, taxes, and fees data.
Mm-hmm.
Your customs broker can provide it. Your current bond provider can provide it also. That's why earlier in the podcast, I hit on the importance of having good open communication with your service providers. If you're asking this question, maybe you haven't thought to talk to your customs broker to ask to have them provide it to you. Maybe you work with multiple customs brokers, so it gets more difficult. Maybe you work with a freight forwarder who then subs out the actual customs brokerage. So then there's even another layer to get through to get to the entity that can provide the information. In a perfect world, I would absolutely love it if every U.S. company got their bond from TRG and had access to this software, because this is really trying to provide exactly what you're asking for as easily, whenever you log in, you can access it. But Joe, do you have any other thoughts?
The only other thing that I would say, especially if you do have multiple providers or you're not sure who your providers are, is you can get that if you have access to ACE yourself, or one of your service providers can get that for you, which is what you're saying.
Right. It's all available through ACE. Another thought, if you reach out to TRG, this is a bit of a roundabout way to do it, but we can run a query through U.S. Customs database to get to the surety or the insurance company that underwrites the bond. You can reach out to that insurance company. Once you get to the right person within the insurance company, they'll tell you who the surety agency is on the bond, and then you can reach out to that surety agency. Again, I don't think that's the quickest way to do it, but I have had clients, who've had to go around the long way to get this basic information.
Absolutely. All right, so our next question is, how do import bonds affect cargo insurance?
Cool. Okay, I love this question. First, it's important to understand why there's so much kind of confusion behind customs bonds. There's three things. If you look at the world of insurance, and customs bonds fall under insurance, they're really a small part for most companies. It's a small premium, a small policy. It's not a big part of your risk factor. But the thing is, if you don't pay attention to the customs bond, it can become a very, very big issue. Year after year, as you see your insurance policies renew, the bond just doesn't get any attention. You have to pay for it. It gets paid for. It stays on file. But then when issues happen, it starts to take up a lot of time and can potentially become a lot more expensive. The other thing is with customs bonds, when you place the bond, you don't get a certificate. You don't get a policy like you do with other insurance products. You don't have really anything to look at. Customs will provide an electronic printout of the bond data, but you got to dig into the customs website to see what the bond is, why it's required. So there really is a lot of confusion behind the bond out there, and it overlaps in people's mind with cargo insurance because they're needed for the same purpose, but they don't touch each other. Again, going back to this compliance software we have, it does allow companies to see the data behind the bond and understand it much, much better, and be able to talk about the bond internally. So you have multiple people with eyes on it, and you start to really reduce that risk of exposure you have by being an importer.
Mhm.
Now, we just talked about the bond is a financial guarantee that protects U.S. customs. Cargo insurance is more traditional insurance. It's property insurance to protect your goods as they flow through your supply chain. So international shipments, domestic shipments, while they sit in a warehouse. But that's it. If you import, you have to have that bond. U.S. Customs requires it. The bond protects U.S. Customs. Cargo insurance is not required, but you kind of be crazy to not secure cargo insurance. And cargo insurance is property insurance to protect your goods if they are lost, stolen, or damaged, or involved in a general average claim while flowing through your supply chain. And I like to try and relate, why is there so much confusion behind the bond? Everybody that imports has a bond, but still the information isn't getting out there to make companies feel good and secure about their bond.
And I think part of that is because bonds happen once at the beginning and then they're kind of just renewed and only brought up if they're insufficient. And so not very many people know what it is or why you have it or why it matters.
Yeah.
Yeah.
So all those reasons play into it, but I can totally relate to the question. We get it all the time, but both cargo insurance and customs bonds are really important if you ship internationally. So you got to be working with an agency that has good communication on them both.
Absolutely. I have two questions about bond writers. The first one is, can you explain what a bond writer is? And the second one asks how, for example, a reconciliation bond works with a continuous bond. How does that writer work with that?
The reconciliation rider, it's a rider. It's not a standalone policy. It's written as a rider on the bond. And it's a tool used for companies. I generally see it used for companies that import commodities. And so they're importing a lot very often throughout the month. And the value of the commodity can go up or down quickly, daily. It changes, it fluctuates throughout day to day, up and down. It makes it difficult to give customs an accurate valuation. So the reconciliation rider allows that importer to look maybe once a month back at entries that were made and flagged under the recon rider and readjust the true value of the goods when the entry was made. Customs wants you to be reporting accurate information. It can be difficult to report accurate information when the value is fluctuating significantly. And that recon rider is a tool to allow importers to get a better grasp on that and be more accurate, be as accurate as possible. You really need to be very accurate with that. So again, it allows you to look back a month at flagged entries under the recon rider and adjust the declared value It's a rider on the bond. You got to talk to your bond provider and say, hey, I'd like a recon rider on my bond. They'll ask some additional questions. It's important that, you have those questions and you have the answer to those questions, because you really want to know you have good footing to be able to engage with recon riders without running into fines or penalties, because customs will get grumpy if you don't do it the right way. You asked about riders in general. The other rider, you have a U.S. Virgin Island rider. If you're importing into the Virgin Islands, you don't run into that all that often. The other big rider is a periodic monthly statement, which would allow you to pay duties, taxes, and fees once a month instead of as entries are made. Again, with the PMS rider, you have to go through the agency to get it written onto the bond, and there is additional premium, there's additional risk. The insurance company would prefer you not allow duties, taxes, and fees to pile up and then pay them once a month. The insurance company prefers that duties, taxes, and fees are paid as entries are made, keeping risk low.
Perfect. Thank you. Next, if there is a company that has multiple importing entities, it may be different sites or different subsidiaries, is it better to have individual bonds for each of those IORs, or to have one big bond kind of under the parent company?
Sure. U.S. Customs will allow for multiple tax IDs to be listed on one bond. Every entry into the United States has to be filed under an importer of record number. Generally, the importer of record number is the tax ID number with the 20 suffix on the end. It can also be a social security number, can also be a foreign IOR, but really for this question, it's U.S. tax ID numbers with that 20 makes it the importer of record number. Customs will allow for multiple tax ID numbers to be filed on one bond. That's a good way to do it. It's not bad. It can save on premium for sure. Depending on how the organization is set up, it can be administratively easier. The one thing you really got to think about is if you are a family of tax ID numbers and you want to put them on one bond, you really got to be aware and be thinking about that. If one of those IORs, if one of those tax ID numbers runs into trouble with customs and customs suspends the bond, then there you go. The bond is suspended for all of those tax ID numbers. Everybody's put on hold until that issue is worked out or figured out. So I imagine if you have one central compliance department that has a good feel for every IOR, every tax ID number, and knows that stuff's flowing the way it has to flow, then maybe multiple tax ID numbers on one bond is the way to go. Now, if that makes you anxious and keeping entries flowing, you reduce risk by spreading it out and having a dedicated bond for each IOR. So that way, if one goes sideways, it just affects that one bond, and the other tax ID numbers or IORs can continue to import as usual.
Excellent. I don't have anything that I would add there. Next up, what do you recommend that importers look for in their surety company, outside, obviously, of them being based in Bozeman, Montana?
Yeah, 3 letters, TRG, right?
Yeah.
Right, Joe? No. No. The U.S. Customs bond world, it's got great agencies. They're great people behind it. You can't play in this game without having experience. If you want to look for an agency that's been around, that has clear communication, maybe you don't get them on the phone every time you call, but you can get to somebody, and a good web presence, look for positive reviews. Now, it's worth keeping in mind that if you go to a general insurance agent, 9 times out of 10 or more, they're really not going to know anything about customs bonds. It's just not a big enough part of their business. They don't run into it every day. So they're going to go to TRG or one of the other 3 or 4 other big agencies out there to get the bond. We would make an argument within TRG that there's a lot of value in having a relationship directly with the surety agency. We believe, customs brokers, freight forwarders play an amazing role. They're so important in your supply chain, but they're not licensed insurance agents. They're subbing out the bond to another insurance agency. We think there's value in getting the bond directly from the agency that issues the bond and can make adjustments to the bond and likely provide really, really good, clear communication on the bond.
I have another question. You, in the presentation, talked about calculating continuous bonds. There's a question about how do you calculate single entry bonds?
Oh, gosh, I haven't thought about that in so long. It's it's the value of the goods imported plus duties, taxes, and fees, I believe,
Yeah.
is the bond size. And Joe, you might have run into this more often than I do, but also, if the goods imported are subject to partnering government agencies
Yep.
such as FDA or EPA, I believe you triple the duties, taxes, and fees. So it gets really big really
Or
quick. And
triple the value.
it's the value. Yeah.
Yeah.
I'm sorry. I should be more familiar with this, but frankly, at TRG, we don't do single transaction bonds. We have price points for continuous bonds that we feel it just makes life a lot easier.
It
If you
really does.
And, Joe, one thing to keep in mind with single transaction bonds, because it's natural, if you don't feel like you're a regular importer, you say, well, I'll do a single transaction bond. But another thing to keep in mind with that bond calculation for a single transaction bond is if you're doing ocean entries, you have to not only place a single transaction entry bond, but you have to place the single transaction ISF bond also. So you're having to place two bonds for each ocean entry if you're taking the single bond route. A continuous bond, customs allows that one continuous bond to cover both the consumption entry or the import entry and the ISF filing.
So there's another question that kind of adds on to this. What are your thoughts on filing anti-dumping and countervailing entries on single transaction bonds instead of having them on your continuous bond?
It can be great.
That's one way to get around increasing the amount of your continuous bond.
And you limit the exposure to a smaller bond size.
Right.
So Joe, we didn't talk about anti-dumping or countervailing except just mentioning it. But that's a topic within itself.
Yes.
And if you are an anti-dumping or countervailing importer, frankly, please talk to TRG. We love talking to you guys. There are ways that maybe you can get a better solution. Anti-dumping and countervailing is never comfortable. It's not intended to be comfortable, but it's worth looking at options. And this question, if you have a continuous bond on file and you're able to place a single transaction bond for maybe one anti-dumping entry, that could be a good solution, but it really depends on a lot of unknowns right now. There's a couple ways to look at it, but that could work.
I think that it is a good solution if you're going to have 5 years of importing very low duty impact items, and then you're going to have one entry that is very high value duty because of anti-dumping, because then that keeps your normal bond cost low.
The exposure to the insurance company. And, the flip side is if you want to make that part of your game plan or your business model, really with anti-dumping or countervailing, the rule number one is you got to make it part of your business model. The CFO, the business owner from the top down have got to be 100% bought in. Otherwise, you're just going to butt heads.
Yes. And if you're going to be importing frequent AD/CVD, that's a lot of paperwork for single transaction bonds and a lot of exposure points.
As I mentioned, TRG, we 99.9% of the time won't do a single transaction bond. But, if you choose to take that route, you got to make sure you have an insurance company that will approve that single transaction bond.
Yep.
That's part of it too. It's not an automatic approval for anti-dumping under any.
The other time that we see that people may consider a single transaction bond is if they normally do general consumption entries and then they're one time doing a temporary import under bond, and getting that TIB covered would substantially raise their continuous bond. Then they may decide to use a single transaction bond for that TIB that covers the difference.
That's interesting to me. Speaking of TIBs, that's one of our yes/no questions on our bond application. We want to know if our bond holders are doing TIBs because it does introduce a new level of risk. TIB stands for temporary import entry under bond. We typically see it in 3 scenarios where companies will import something and fix it and send it back out, import something and use it in a trade show and then send it back out, or they import something and destroy it. So they rarely import, and you can file it in a way with U.S. Customs where you avoid duties, taxes, and fees if you export it or destroy it by a certain date and provide proof of that. Now, with TRG, we just want to collect some data to make sure the company engaging in TIB is doing it in a thoughtful way, because it can absolutely be a helpful way to do business. But if you don't plan it out and you don't have an idea of what you're doing, it's going to bite you in the butt, and customs will hit you with a big fine. But Joe, that's interesting. We've never considered having to do a single transaction bond for TIB. We just collect some information, and if the importer feels like they're doing it the right way, generally it's a non-issue.
Right.
Generally.
And it just depends on the commodity, usually,
That's
as to how much of an impact it's going to be. All right. Next up, how do we reduce bond amount with our surety company, because import duties, tariffs, and taxes are a lot lower in the last 12 months now that the COVID bubble is over?
Okay, cool. Yeah, good for you. We tend to focus in these talks about potential, rises, because that's what causes the most heartache. But if you currently have a bond that's bigger than a 50K bond, I would wait till that anniversary date to lower the bond size, because you paid premium up until that date. But about 3 months ahead of that renewal, tell your bond provider. It shouldn't be that hard. You have your data, they have it too. They can confirm that the previous 12 months are at a volume of duties, taxes, and fees, that a lower bond size would be sufficient. Doesn't go without saying, but it's important to note that you, as the importer of record, you're the only one that knows your future trends. So you absolutely got to consider the next 12 months too. But if you check those boxes, the previous 12 months and the next 12 months, and a smaller bond size works, then there should be no issues. Part of that too is to keep in mind customs is U.S. customs, and nobody's going to tell you when you're over bonded. Customs will tell you when you're under bonded. A good surety agency will tell you way ahead of time when you're trending towards being under bonded. It should be a simple process to reduce that bond size. The insurance company wants that exposure to be reduced too, if it can be. So it's a win-win.
In addition to 301 duties, what are other considerations to keep in mind when reviewing for bond sufficiency?
Well, we had that slide that lists, harbor maintenance fees. There's about 6 or 7 excise tax. And for most companies, a lot of those don't play significantly into the calculation, but it potentially could. Anti-dumping and countervailing is just so huge, and that's important while calculating the bond size, but also as companies consider importing from new suppliers or new commodity, you gotta pre-classify. You can plan out your bond, but if you have a purchaser out there that says, hey, I got a great deal on this widget, but it ends up being anti-dumping, all that planning goes to heck. And you're back at square one once that anti-dumping entry or that good subject to high 301 tariffs starts coming in. Pre-classified before goods are ordered. It sounds like this person is already looking forward 12 months and doing the right stuff. But I would go back to that slide that mentioned excise tax, harbor maintenance fee, 301 duties, taxes, anti-dumping, countervailing. That's what I would consider. I ran into one scenario once where we placed a bond for a company. They failed to tell us that they still owed back taxes on customs entries. I really felt bad. We ended up placing, it was a pretty big bond, but it still wasn't big enough to account for that big chunk they paid to customs. But I can't imagine anybody is going to run into that scenario. It's any money owed to U.S. Customs. This importer had to pay back taxes. They didn't include it in their bond application with TRG, so we couldn't know. And they did end up having to increase their bond.
I agree with all of that. So think about where your new suppliers, think about where you're ordering from, because sometimes you may not have anti-dumping on a certain type of product from one country, but it is from another country. So really be aware of any changes in sourcing. And then also, if you're doing any sort of acquisition or merger, you'll need to know about their practices and keep an eye on that for bond to increase. And then exactly what Travis was saying, if you have liquidated damages or other back duties or anything like that, that can impact your bond amount. Can you reinstate an expired continuous bond that covers a TIB?
TIB questions. No. Once a bond is terminated, it's terminated, and you just go to the bond provider and apply for a new bond. And I'd imagine this question is being posed because there's some difficulty in getting a bond to do temporary import entries under bond.
If there's a TIB extension or something.
Oh, TIB extension, huh?
Yeah, well, could be.
Yeah, I mean, Joe, as far as I know, once a bond is terminated, that bond number is dead. any liability, any entries under that
Exactly.
period exist.
Yes.
So the liability can still exist, and that's a big takeaway from an underwriting perspective and understanding where the insurance company is coming from. Just because a bond is terminated, that 50,000 or 100,000 or 1 million, whatever the bond size was, is still active. That liability is still active until all entries have liquidated. So I don't know if that answers that question great, but maybe.
If not, I hope they'll let us know.
Yeah, we can still loop back around. Yeah.
How hard is it to recover collateral like an international letter of credit from the surety company? Do you recover small amounts over time, wait until all risk passes, and then get back the full ILOC, or is it released? How does that work?
Oof, case by case. I'm
Okay.
sorry. It's not, you know, it sounds like an international ILOC. So maybe this is a foreign company with US IOR, a foreign IOR. But, once guys, the insurance company, they don't want to collect collateral. They don't make money on collateral, but it sometimes is needed to provide the security to get an insurance company to write the bond. The insurance company, generally speaking, 9 times out of 10, is going to keep that collateral until all entries on that bond period have liquidated, plus a waiting period of like 90 days or something like that.
And liquidation
Yeah.
can take a very long time depending on what types of entries are on that bond.
Generally, it's, Joe, it's 314 days for standard entries for anti-dumping or countervailing. That's case specific. It can be years and years and years. And that, that's a whole nother discussion, but that's part of the reason why anti-dumping, that's a big reason why anti-dumping is so touchy, so difficult to work with, is the exposure, the risk compounds, and it stays on the bond for a very long time. Nobody wants to have collateral tied up. The insurance company doesn't want to manage it, but they're absolutely going to cover their bases until the entries have liquidated. You might be able to get them to step down gradually as big chunks of entries liquidate. If it happens in big chunks, you might be able to. But at the end of the day, it comes down to the underwriters at that insurance company to agree to do that. But you're probably going to have to wait till everything liquidates plus a waiting period. Sorry.
Yeah, I agree. It is unfortunate. If there is an importer looking at maybe their surety company invoice and that surety company invoice itemizes the automated surety interface, what does that mean?
In the world of insurance, well, it depends who the provider is. I think if you get the bond through a customs broker, freight forwarder, they just show you one number.
Yeah, one lump sum. Yeah.
One lump sum. Now, like TRG, we do break it down. You might be asking as a current TRG bond client, but we have premium broken down and we have ASN, automated surety interface. And that you could call it an admin fee or whatever you want to look at it as. That bond provider is using that money to maintain the IT interface with US Customs to get this surety ACE data that we were talking about earlier. So every bond provider, whether you as a bond holder get that data and use it, you might be a really small importer and don't necessarily use it all the time, or you're not too concerned with it. The bond provider still has to maintain that IT interface, the automated surety interface with US Customs to be able to place bonds, term bonds, make adjustments to bonds, get communication from Customs on potential claims. That's part of the cost of being able to be a bond provider.
And you're paying for it whether it's itemized or not.
Yeah, that's what I'm going to try and say, Bill. I mean, at the end of the day, you look at the total, right, and see if it feels competitive and if you're getting good customer service is the other part of it.
Does that surety report that you get tell you if an importer is impacted by anti-dumping and countervailing?
So yeah, it does break down the entry summary. You can see if it's an 01 entry or an 03 entry. The other thing I really like about the entry summary is it also shows the filer code. I think I mentioned it during the presentation, but yeah, Joe, you can identify anti-dumping or countervailing. You can see the anti-dumping or countervailing duties. You can see the standard duties. That's all included in that compliance software. And then if you have to go back and try to address a specific entry, you can look at the filer code on the entry to find the customs broker who actually hit the buttons. Now, many of you probably have a direct relationship with your customs broker, but there are plenty of importers that don't have a direct relationship and kind of have to figure that out if something arises.
We also got in a ton of questions about 301 and I'm not going to throw them your way, Travis, because we need to wrap up just to be mindful of everyone's time. There are a bunch about how it'll impact your bond, and the answer is if the duties are going up, you need to check and see if your bond amount is sufficient. We do expect China will retaliate. I don't forecast how,
It's going
but
to be tit for tat. They're
yeah,
going
they
to
are.
subsidize. They're going to I mean, I don't know, but they're going to subsidize the goods that the Biden administration has imposed 301 tariffs on, and
Yep.
they're also probably going to expect them to hit U.S. farmers.
Yes.
We do export a heck of a lot to China, but not in the volume we import. Of course, there's the trade deficit, but they're going to hit us where it hurts.
They
Middle
will.
America, farmers, agriculture, livestock.
Yeah.
Yeah.
Part of the slides that are up on the screen right now that we'll send out again in the next couple of weeks, we have a link to TRG's website. There are a couple of links to different notices on 301. It includes the notice that the exclusions are either not going to be extended or the few that are. It also has the request for comment on the increase. So you still have a couple of days, a handful of weeks to get in there and comment on the 301 increases that USTR proposed. Then there was a question about, can we tell customs about a product made in China that isn't included in 301 that has unfair competition? You can't really tell customs, but you can tell USTR if you want them to include it in section 301, or you can escalate it to, I believe, the ITC about anti-dumping. So you can say, we believe that there's dumping going on here. So you can report it. You just probably wouldn't report it directly to customs. And if you want to know more about it, you can email us and I can give you more detail on where specifically you would go. There will be a recording available to review. Thank you all again so much for watching and asking questions. It was a really fun opportunity. I learned a lot, so thank you so much, Travis. If we did not get to your question, please feel free to send us an email and we will either pass it on to Travis and Meredith, or if it's more in our wheelhouse, we'll answer it. Travis, thank you again so much for joining us. And we will send an email in the next few weeks with instructions on how to claim CEUs with NCB FAA if you participate in their programs, along with link to the slides and recording. And you are so welcome to reach out to any of us. I know Travis would be happy to answer any questions that you have. And we hope you'll follow TRG because they have a lot of really great info to share.
Thanks, Joe.
Thank you, Travis. Do you have any closing words you want to say?
Thanks for everybody. Reach out with questions. We just got to get communication going. There's too much confusion out there.
Excellent.
We're available.
Have a fantastic rest of the week. We'll talk to you all later.